All right, guys, May was a very volatile month in stocks, and I believe the S&P total return with dividends was about a 0.8% gain in May. Okay, now that's big because 0.8% times 12 is 9.6, which is about the historical average. But we had some major fluctuations. Even in my swing trading account and my short on QQQ, I saw massive swings. Is that a bad thing? Well, volatility can be scary. But what we want to do here is talk about what are the parameters in the stock market now. How do they view the future? How does it project out for the future? And also the economy. So those of you who've watched our channel for a while, there are three main valuation metrics in the stock market that I care about. The first one is stock market to GDP, which Warren Buffett has called the single most accurate metric of stock market valuation at any given time. The 10-year cyclically adjusted PE ratio. What that does, it takes the last 10 years of earnings in the S&P, brings it all to today's dollars with inflation, CPI, and then divides the current price into that. We usually do a 1-year PE, but what was created many, many decades ago, about 100 years ago, was looking at the 10-year earnings and bring it into today and divide the market by that. And then the third one is the price to sales ratio. Now, I don't have a lot of data going back on price to sales ratio. It goes back to about 2000, but it's a good metric to compare to the 2000 dot-com bubble. So let's start with the stock market to GDP ratio. It is currently 169.8%. Okay. Now, to take that in consideration, in 1982, the bottom of the market, the bottom of the secular bear market, that ratio was 32%. 32%. Over 5 times more today than it was back then. All right. In 2008, the bottom of the financial crisis, it hit 52%. And by the way, the bottom of the financial crisis wasn't some screaming deal of all screaming deals. Was it better? Absolutely. But if you look at long-term historical averages, it was pretty good, okay? So we're at 169.8, which is better than the 209% we were at very recently. So right now, based on history going back 100 plus years and looking how the stock market returns based on certain levels, we should expect 0% returns over the next 10 years, including dividends. Now, I know a lot of you are looking at that going, come on, 0% returns? Guys, go look at the data. Go look at how the stock market did in 2000 for the next 10 years. Go look at how it did in 2006 and 2007 for the next 10 years. Go back to 1966. Look at that data going the next 10 years. It's not pretty. Does that mean you shouldn't invest? Oh, well, Paul, if I'm going to get 0% returns, I shouldn't invest. No, because guess what? The market's going to go down and you still need to be able to buy all along the way. So you dollar cost average and buy at very low prices as time goes on. So don't get scared. The only reason you should even be thinking about worrying, if you plan on retiring in the next 10 years, I would consider this. I would look at this and say, wait a second, how does that change my goals in the future? The second one, the 10-year cyclically adjusted PE ratio. It's currently at 32.52. The historical average going back to 1870 is about 17. So we're almost double where it was before. Now, guess what? It got as high as 38 or so recently. So it's come down quite a bit. So again, also screaming overpriced. Does that mean exit? No. It just means be ready for volatile markets. Be ready for big drops. But the good news is, in those big drops, it'll allow you, if you dollar cost average, to keep buying at much lower prices. History has shown that for a new secular bull market to occur, we need this number to get to single digits. Does that mean the market's going to fall 60% from here? Not necessarily. What it means is that as the economy gets better and stocks fall, there'll be an evening out where stocks have to fall 60% to get to single digits. Okay? Again, if this incites fear in you, that's not the intention. My job as an investor is to evaluate the market where it's at, evaluate companies where they're at, evaluate real estate where it's at currently, and make decisions based on that. But if you're here for retirement, your job is to dollar cost average every month. Sometimes you'll overpay, sometimes you'll underpay. Over time, you'll pay about the market's average. The third metric is the price to sales ratio. It is currently 2.65. Now, it got over 3 recently. To keep that in perspective, it was around 2 in 2000. So we're still 30% above where it was in the 2000 dot-com bubble. Now, there's a million reasons why we can say all of these metrics don't matter anymore. This doesn't matter. It's all chitter chatter. These are the three most reliable metrics on long-term value for the stock market, and they're all screaming overpriced. Does that mean sell everything? No, because they screamed overpriced 3 or 4 years ago as well, 5 years ago, and you missed out on a lot of gains along the way. So don't do that. Just be ready for volatility. The big thing we do on this channel is to prepare people's emotions, because it's been proven time and time again that the more emotionally even keeled you are in investing and stick to your plan, the better you do in the long run. When you're jumping in and out based on what these metrics say, you will lose over a long period of time. You will not make as much money. Okay? Very simple. Guys, that was the stock market data. Now for the economic data. Inflation has been big lately, and one of the biggest drivers of inflation is gas prices. Everyone's feeling it at the pump. We are at all-time highs in gas prices. How bad is it? The average gallon of gas right now is 4.694 per gallon. Okay? Last week, it was 4.591. So it's up 10 cents per gallon. In the last year, though, it is up 50.55%. Guys, I don't care who you are. That's going to hurt. So when gas prices are high, it makes products cost more. It makes traveling less likely. It starts to hurt the economy. That's just the way it is. Not good or bad. For those of you who properly save and live well below your means, this will just chip away at your savings. Is this permanent forever? Probably not. We were at high gas prices in 2008. 2007, we saw $4 a gallon of gas. Everyone went crazy. Things started to settle down. We hit a recession. Gas prices came down because when a recession hits, demand decreases and prices start to fall. Okay, guys, new home sales just came out. 591,000 units were the pace for home sales. This was versus 709,000 in the previous report. So it's down significantly, right? Not quite 20, probably 15%. Now, to give you an idea of where this sings, it's down 27% from last year. Guys, this is a big number. Why? Lumber prices are higher. Inflation's higher. Interest rates are higher. We'll get to that shortly, but interest rates have gone up so much, it is hurting new home sales. When you had 2.75% interest on a 30-year mortgage last year, now it's 5.25, almost doubling, it's going to hit people's ability to buy units. Now, how do these numbers compare to the past? Well, this is what we have to look at here. In 2005, right before the big bubble, right before the bubble crashed, July of 2005, we were selling 1.389 million units, new units per year. So we're at 60% lower than that right now, maybe more than that. In February of 2011, after the crash and things were hit its low, we did 211,000 units. So we're still 2.5 times higher that number, almost 3 times that number. So it is way better than then, but it's way below here. Do I want to be here? No, this is oversupply. These are too many units. You're going to flood the market. Prices are going to fall. It was just euphoria. Okay. So now, since January 1963, when this first metric came out in January of 1963, the average has been 656,000 units. So we're a little bit below that average. Now, are there other indicators? We had people, the baby boom market hit and they started buying more houses, of course. But this just shows where we are relative to history. And I wouldn't look at this metric as comparing to 656,000. You need to compare it to other indicators in the economy. How did the economy differ in terms of people and houses back then versus today? 591,000 is a low number compared to where we are historically, but it's not something to be devastated about quite yet. Now, guys, the next metric is the 4-week moving average of unemployment claims. This takes the previous 4 weeks, the average number of unemployment claims made in the last 4 weeks, and compares them on. We are currently at reported 206,750, which is higher than the previous week, which was 199,500. But it is down 60% from last year. Now, remember, if you look at the unemployment claims numbers, here's the interesting thing about the chart. It's like this, like this, like this, like this, COVID, like this, and back like that. We saw record unemployment numbers in COVID, right? The previous highs were 800,000, 900,000 a week in 2008 and 9. We got to in the millions up here. So it's kind of hard to look at the chart. But if you want to compare this historical average, the historical average is 350,000. So we're still doing well compared to historically. We're still well below that. But unemployment tends to be a lagging indicator to the economy. When people start to feel the recession, all of a sudden they go, whoop, let's start not hiring as many people, let's start laying off more people. So that's the thing I'm looking at here is I'm not concerned about this number quite yet. I'm looking at other metrics to say, what is causing other issues in the economy that might drive this number up? Because right now we're at record unemployment not record, but it's very low, 3.6, 3.7%. But it's, again, like everything, it's not one indicator that's going to tell you. If all the indicators tell us, oh boy, then we have a problem. But right now, it's not everything telling us that. So mortgage rates, like I talked about. About a year ago, a 30-year fix was 2.75. It is now 5.25%, which is down from last week, which was 5.3%. Guys, this is going to, if your cost for a house doubles, if you buy a $300,000 home and your rate went from 2.75 to 5.25, you're talking about an increase of $625 per month. And if you're buying a $300,000 home, $625 a month does matter to you. This will cause a slowdown in home buying. It has to. It might be delayed a little bit, but it has to cause a slowdown in home buying. Is there still a lot of pent-up demand because of lack of inventory? Absolutely. There still is lack of inventory. We're seeing at historical low levels of inventory. But you will be crazy to think that this jump in such a quick period of time would not cause some sort of slowdown. Now, the Case-Shiller Index just came out this morning, and it showed a 21.2% increase nationwide in the values of homes over the last year. Over 3% in the last month. We're usually getting 3 or 4% in a whole year. We got that in the last month with 21.2% growth in 1 year. I think I saw Dallas at 30%. Phoenix had almost 40% growth in the average price of their home in the last year. Guys, pent-up demand, increased costs, labor, materials, everything is driving that up. I would not get too euphoric and thinking to yourself, oh, this doesn't matter. This will matter. We have a great friend of the show, owns a big mortgage company. I love him. He doesn't think this is going to affect it much. I love him. He's probably watching. I respectfully disagree. Right now, there is pent-up demand, so it can mask this. But eventually, when supply and demand starts to happen, starts to equate out, this will be a big driving factor as to why people aren't buying more homes. Especially if we do hit a recession, this will help. This will drive down prices more. Does that mean we're going to have a real estate crash? Absolutely not. Am I calling for it? I have no idea what's going to happen. All I know is when I look at the prices of homes since 2020, I believe this Case-Shiller Index in 2020 was around next level of 220. And today, it's north of 300. That's a 40% increase in a matter of 2 or 3 years, 2 years. Guys, that's not sustainable. Now, does that mean it has to come crashing down like this? Not necessarily. If they do a good job of managing things, which then we could have this big run up and then home prices are more likely to stable off. Because remember, before the 2008 financial crisis, I believe there had never been a year-over-year drop in home prices nationwide. In certain markets there had been, but nationwide we had not seen that. In my, Tim here is my age, Seth's my age, Mo's a lot younger than me. I was used to seeing prices of homes go like this, like this, like this, like this. When your parents or older people probably used to home prices like this. You just bought a home and over time it just went up in value. You paid down your debt, inflation took over, income took over, and your home went up in value. To be honest with you guys, I'd rather have that. But right now, we're still in really weird economic time in the last 15, 20 years, low inflation, and now it's starting to catch up. It's okay. All the more reason to adhere to what we talk about, which is save your money, live well below your means. That way, when those prices do increase, when those rates do increase, and you still need to buy a home, you can afford to buy a reasonable home. So inflation's been a big talk lately, and everybody's talking about 8.5%. The U.S. government has their PCE level of inflation. Now, what did it end up at? It fell to 6.27% from 6.61%, which is a nice drop. Okay, it's not the 8% we're reporting. It's the government's way of looking at it. Now, how did that compare to history? Well, it's up 75% from last year. Okay, guys, typically we're going to be the 3 to 4% in history. In the last 20 years, we've been 1.5 to 2.5%, if that. So inflation's still high. They're still going to keep working on getting this number down a little bit. Spoiler alert, guys. My personal opinion, and this is something that's very controversial because people don't want to hear this. I don't believe the government wants to lower inflation. Remember, As a country, we've taken on a massive amount of debt in the last 20 years. And there are only two ways to pay down debt. There's only two ways to decrease debt relative to your income. One, pay it down. Or two, inflate the heck out of the economy. Because if you have $30 trillion in debt versus $25 trillion in GDP or 28, whatever we're at, if you inflate the heck out of GDP and make it 50, how bad does 30 trillion look now? It went from over 100% to 60%. So when I hear government talk about, oh, you think the government's going to pay down debt? Have they ever paid down debt? Have they ever? I mean, I don't remember the last time the government actually sat there and said, oh, we're going to pay down this debt. You go back to World War II and it was inflation. Inflation helped a lot. I don't know how much debt they paid down, but the government is not incentivized for paying down debt. So what do they want to do? They want to inflate the heck out of it. Because guess what? Let's go to extreme. If we had 10 years of 7% inflation, that would basically double. We'd take our $28 trillion in GDP, I don't know exactly what it is, and it'd become $56 trillion. If we can just, even if we borrow an extra $1 trillion a year in deficit, we have $1 trillion a year in deficits, that only takes our debt to 40 trillion. We're still well below that number. It looks a lot better than it does today. Inflation is a debt, or that's why inflation's good for real estate. If you have a mortgage on your home, your real estate price is going to go up, your income's going to go up with inflation, but your mortgage payment stays the same. That's why the government wants inflation. So right now, it's high, and they're trying to combat it, but I believe they're going to let it ride a little bit longer than people want. Plus, it drives income up. Even though it's nominal income and not as much real income, it still makes people feel better when they're getting 6-7% raises every single year. Now, the one I've held for the last one is consumer sentiment. This one matters to me. 70% of our economy is driven by consumer spending. The index of consumer sentiment fell to 58.4 from 65.2. This measures, they survey people, say how likely are you to spend money, how comfortable you feel about spending money. This is a big drop. Here's how bad it is. At the lowest level of 2008, which was the pit of the financial crisis, we were at 55.3. We're currently at 58.4. In 1980, when we were coming off of major inflation, massive inflation of years of inflation and high interest rates, it was 51.7. In February of 2000, which was the peak of the dot-com, April of 2000 was the peak of the dot-com. The economy was soaring. It was 111. Guys, these are concerning for me. This does concern me. Out of all the data we saw, I was like, okay, this is in the economy. Okay, not good. Okay, fine, whatever. This is the one that worries me. This is a big plummet in consumer spending. This is big. And we're a few points off of the low of the February of 2008. The low when people are like, I ain't spending money. I'm losing my job. And we're there. And we have 3.6% unemployment. So in this economic and stock market recap, it's not meant to incite fear. Because remember, when things are their gloomiest, I'll say, guys, there are better times ahead. But it's impossible to have amazing times ahead in the short term when things are already booming. Just saying, be cautious. All the more reason, save your money, live well within your means, and be ready for any sort of thing that might happen. You will be fine. You will do great. Keep watching our show for these updates so you can get a feel for what's going on in the economy and the stock market.